Hello, and thank you for tuning in to another edition of the Monthly Market Roll, where we provide a look back at the economy, markets, and investments, and other macro data from last month. And then we roll into this month with our insight for what lies ahead. And I'm joined by...
Hi, my name is John Cox. I'm Chief Investment Officer of Public Markets at Waverly Advisors.
And I'm Brad Rathe, Partner Senior Director of Portfolio Management at Waverly. And I'm super excited. This is our first one with John and I. I know John reads a ton, so I think this is really going to be a great conversation. Reads on markets all the time, really digs in. Been doing this a long time. Him and I are probably about the same age, so I know we've both been doing it. So I think I'm really kind of looking excited for this. John and I've been been working together for a while, and so I think this can be fun. So I'd say, John, let's just get right into it. What are you seeing this year? What are some of the key data points, the themes? Generally, it's been an up and down year up to this point. What have you been looking at? What are some of the key things that you've been looking at, John, so far this year?
Well, first of all, thanks for having me. The first quarter of the year was pretty good for economic growth. The growth number came in about 1.6%, not quite as good as it was for the last couple of quarters of 2023, but still positive. And I think that number was a little bit misinterpreted because of some factors that caused it to be below 2%, but nonetheless, pretty good growth. Second quarter GDP, just kind of quarter to date, is already looking much stronger than that. Obviously, we're only 5 weeks into the quarter, so things can change. But the unemployment rate has stayed below 4%. Job growth has been good. It's slowed down a little bit, which is not necessarily a bad thing when we're talking about what the Fed might be looking at in terms of interest rates. Another thing that's been fairly positive is that the price of oil has stabilized around $80 a barrel. So, we didn't want to see it spike up to 100 or go even higher than that. So that's a positive. And the 10-year Treasury, which is kind of a barometer for interest rates, has remained in that 4 to 5% range and is currently around 4.5. So that's led to a good first quarter. April, and I know we'll talk about this a little bit later, but April was not a great month, but we've seen a little bit of bounce back in May in terms of market performance.
Well, and I think that brings up one of the biggest factors. I mean, obviously we had a little bit of rough period, and you were talking about that before last month. And, I'd say generally what were some of those things that created, I'd say, generally lower, equity markets? I think it's Fed inflation. Talk a little bit about the Fed and what you've seen there. Inflation, because I think that seems to be probably a main factor of why, as interest rates went up, you saw the equity markets fall off. You had the same thing last fall, and then interest rates came off, and then equities rallied to the end of the year, and then the first couple of months of the year. Is that the main driver that you're seeing that seems to be driving equity prices, especially last month of what happened?
Yeah, I would agree. There have been 3 straight months of inflation reports that have been a little bit stronger or hotter than expected. But that's coming on the heels of the prior 3 months that were lower than expected. So that monthly inflation number is going to bounce around a little bit, and investors are going to pay probably too much attention to 1 or 2 data points. I think the trend in inflation is still towards getting to the Fed's goal of somewhere in that 2 to 2.5% range. Might take a little bit longer to get there, so the market's kind of focused on that, as well as the pace of the Fed cutting interest rates. So coming into 2024, there was even some economists who were thinking there would be anywhere from 3 to 6 interest rate cuts. The Fed had telegraphed that it'd be more like 2 to 3, and I think we're still kind of in that 2 to 3, possibly maybe just 1, but unlikely that the Fed reverses course and starts hiking interest rates unless we see several more months of higher inflation reports. And that's just not the base case that we're expecting.
Well, I think that was the fear going into that last Fed meeting, right? That they were going to start to say, maybe we need to increase rates. And that was, I would say, the 2 days prior to the last Fed meeting, you saw the market really start to fall apart, thinking, oh my gosh, is he going to talk that we're going to increase rates after we've been talking about 7 rate cuts this year? And all of a sudden now we're going to have an increase at some point this year. And I think that was the spook to the market. But him coming out, calming markets at the Fed meeting, you saw has had a really quick pop, this month, and you've seen really good performance this month. But as you can see on this graph, like you said, I think people are a little bit myopic on the short term. But if you look at this data point, you look at the inflation numbers that we're looking at here, it's really within reason, right? It's a certain band. So no, I'm with you. But how about a little bit on just generally the equity? What did you see? Was it concerning to you? Was it just a normal? What would you say? And these are just some numbers I just pulled up. We just did, large cap, mid cap, small cap type of numbers just for last month. What do you take from last month in general with the equity
Yeah, I
markets?
think April was just a normal kind of pullback in the markets after 5 straight positive months. So you have to go back to October of last year to have, to when we experienced a negative month for the S&P 500 and for most of the other asset classes. So, you don't typically have 5 straight positive months. We did.
Okay.
We gave a little bit back in April. That was, again, was it because of those inflation reports? Was it because of the Fed kind of pumping the brakes a little bit on potential rate cuts? Or was it just the market kind of taking a breather after a strong period? And so if you look back in market history, a 5% decline in any given year is not uncommon. In some years, we have two different 5% declines at different points during the year. So I think as an investor, as a long-term investor, that's just something that you have to kind of get through. You have mostly positive months, but you do have the occasional pullback like we had in April. We've started a little bit higher in May. It could stay that way, or it could reverse course. Again, I think the market is focused on inflation. That we'll have another inflation report that comes out. The jobs report that came out earlier this month was pretty good for the economy and the markets because it was 175,000 new jobs created, which was lower than had been in previous months, but it's still a pretty good number. And wage inflation is still pretty good, so that's good for the consumer. Prices at the pump have gone up a little bit, even though oil has stabilized. Seasonally, that's not abnormal. Usually, as we approach kind of summer driving months, you see a little bit of a spike in gas prices, and then it starts coming down a little bit later in the summer and into the fall. So, all in all, I think it was just sort of a normal month in April. Not something to be too concerned about, but I realize as investors, we don't like to see negative months, but obviously it does happen occasionally.
And I think this is another example, the weaker ISM numbers, going below 50. And this was early in the month. I think this was one of the things that sparked a little bit of that move down. I'm with you, though. I think there's always volatility in these numbers. I think you have to have some rationality around it, and whether it be jobs but you always have people that are going to talk about uncertainty. You do have to be a long-term investor. I think you have to kind of look through some of these things sometimes. But as you know, we're always concerned. We're always looking at things. We're always trying to figure out what's going on, and we want to know. We want to be prepared. For what's next. But let's talk about. Give me a general view. We're going to roll into May here. Give me your general view. Let's say this month, the rest of the year. What are you seeing? What are some of the key things that you're looking at to, gain an inkling on, what's going to happen the rest of the year? Just, give me some general thoughts of what you're thinking for the rest of the year.
Yeah, I think people have been so focused on investors in particular have been so focused on inflation and the Fed that they've sort of maybe forgotten about what drives stock prices over the intermediate to long term, and that's corporate earnings. And so we had, corporate earnings growth was not great in 2023. There's higher expectation, a little bit more optimism in 2024 that we will start to see profit growth. The first quarter was put us on a pretty good path. We had a lot of earnings surprises, and so all in all, I think we're off to a good start. We'd like to see that continue on throughout 2024 and into 2025, and I think markets will potentially move higher on that news. There are obviously a lot of things going on geopolitically in the world. There are things that might come out of nowhere and surprise us that they're just not on the radar screen. But I think recession is not a likely scenario at this point when we look out over the next 12 months. The Fed will cut interest rates at some point. I don't think they will stay at 5.25% to 5.5% for a long period of time. So when the Fed does start doing that, that could be a catalyst for market appreciation. And there's just other factors at play. I know we still the election is still a little bit away from us, but the second half of the year in an election year tends to be pretty positive for the markets. Yeah. So it doesn't happen that way every year, but that's something that could be also a catalyst for better performance going forward.
Well, that one of the things that I've been looking at is, I think exactly what you're talking about on the Fed, which is this length of time that they've been haven't increased or decreased rates. They've been flatlined. This is probably going to be one of the longest periods in history. And I think that's what's been weighing on the dollar. And that's obviously thinking about our international exposure, looking at different, from credit, around the world. I think this has been a big play. Obviously there's been some intervention in the yen, and that's caused some disruption in EM markets. And so this has been one of the areas that I've been looking at, just to you're always looking for uncertainty and what can go around the corner, looking around corners to try to understand, what some of those risks are. What are some of the things what worries you? This is kind of my worry. What is something that is kind of worrying you, would you say, if you had a kind of a top worry, right now, what would you say that would be?
I think commercial real estate is kind of been on everyone's list. It's kind of been put a little bit on the back burner because of other factors, but occasionally you'll see a bank that's very exposed to commercial real estate loans that reports some troubled assets on their balance sheet. I don't think it's a systemic issue. I don't think it's anything like back in the financial crisis in kind of 2007 to 2009, where you had a lot of banks that were on the brink of failure, and the FDIC had to come in and bail them out. Obviously, we had Silicon Valley Bank last year. There were
Yeah.
two other fairly large banks that needed assistance from the Fed, and we've heard a little bit in 2024. I think that's something to be mindful of. The publicly traded real estate companies have it seems like they've adjusted to downward prices,
Yeah.
and I'm not sure that the private markets in real estate have fully reflected the dynamics that have gone on there. That would be one thing. That's not again, I don't think it's a systemic risk to the whole economy. But I mean, I think you can identify some things that are not quite as good as we want them to be, but there'll always be a
No doubt.
situation like that. But when you look at all the good things out there and kind of weigh it against maybe the negatives, I think on balance, we're definitely a little more optimistic than most folks are at this point.
Yeah, and there's no doubt that lower interest rates would help help in that situation, and obviously help a lot of things. You already talked about the earnings, but I think just high level, we've had what 80% of the companies reporting, 77% have been positive, above their EPS, which I think is about 10% over normal, and we're looking at earnings growth five, which is really good. I mean, at 24, if we can come out with a five number, you put that in, thinking about how you value companies, that's going to make that PE number look, a little bit more reasonable as well. Let's get last thing, just, looking at, I think this type of thing makes sense, right? Where you had real estate down 9. I would say probably the biggest one is energy being up 12. Give me a little bit on your sector and some of the, internals of the market. What are some areas that you like, and what are you seeing, I guess, from an internal standpoint, in the market right now?
Yeah. When you look back at April being a down month overall for the markets, usually the more defensive sectors hold up better, right? And so you see consumer staples were just marginally negative. Utilities were actually positive.
Yeah.
Energy markets did stabilize. They were coming off of a good 2022, but a poor 2023. So just from a rotational perspective, energy companies did well. We've been in a period for at least the last 12 to 15 months where those handful of technology stocks have done so well relative to everything else in the market. And so it's a good thing to see that broadening out a little bit. I know when in April, most things were negative, so it's not very evident. But when you look at kind of the year-to-date numbers, you can see energy's doing well, energy stocks are doing well, financials are doing well, technology not quite as well. And so you're starting to see other sectors kind of take the lead. I don't know if that's a trend that will continue, but I think it's healthy for the markets if you see a broadening out, and it's not just those handful of what they refer to as the Magnificent Seven stocks generating all the performance in the market.
Well, I think people can be stunned to see that technology is actually the third worst this year, and I think that's really good for the market to see that broadening out, like you were saying. So no, I agree. John, this is a great discussion. Really enjoyed you coming on. To end with a little bit of just general sentiment, what you're seeing, what you're thinking, for the rest of the year.
Yeah, again, I think there are reasons to be positive, and I think in terms of the economy, if we were looking at an economic downturn, if we were looking at corporate profits declining, we would be a little more cautious. I think valuations might be a little bit higher than normal, but interest rates, if you look at the 10-year Treasury being around 4.5%, that's sort of a normal level if you look over the last 20 to 30 years. We just need a little bit of momentum to build in corporate earnings and the consumer to kind of stay strong. We need the job market to continue to produce jobs and be positive, but to not be so strong that the Fed stays on hold with interest rates. Because, like you mentioned before, we need, if we see interest rates, the Fed controlled interest rates, the Fed funds rate come down from 5.5% down to 5% and then down into the fours, I think the markets will respond to that. And that's only going to happen if these next few inflation numbers come in as expected, more like kind of 0.1, 0.2% per month, as opposed to what we've seen the last few months that have been 0.3, 0.4% per month.
Awesome. Thanks, John. Yeah, I'm with you. I'm really excited on the fixed income side. I think it's going to be, different market compared to what it was, the last 25 years. But thanks for listening to Monthly Market Roll. If you like what you heard, have any questions about the topics John and I discussed here today, feel free to reach out to any of the Waverly Advisors. Information on how to reach us is in the description. You can get more information on waverly-advisors.com. Thanks again for watching, and we'll see you on the next video.